Very good afternoon and welcome to HYCM's online webinar with myself, Giles Cochrane, Chief Currency Analyst here at HYCM. We're now going to have the FX week ahead live market analysis as we look ahead to what we have coming up in the coming week. And we have a very busy time in the markets at the moment and there's a lot going on. So I'm looking forward to just taking us through what's ahead in the coming month. Now, the first thing to really underscore is that August can be quite a volatile month, and I'll just go through the reasons for that during the webinar. But just to remember, we could see some quite large price swings in August, so be aware of that. Now, first, to make it clear that as we're going through different trade setups, potential entries, exits, support resistance levels, etc., etc., the whole idea of this webinar is to show you, as you look over the shoulders of someone with a professional trading background, how I go about making decisions, understanding market moves, deciding where I enter and exit trades. The idea of this is not to be a signal providing service, so it's an educational perspective. So just to make that clear, special welcome to you if this is your first time here on the webinar, and also a normal welcome to the regular guys. Great to have you on board as always. Salvatore, Jacob, Sammy, great to have you. Shwa, Zayed, Omid, good to have everybody aboard, and if it's your first time, a very, very warm welcome. During this time, what I do is I take traders through the coming week, and we're going to start by looking at key events that we have. Now, some key things to be reminded of. Now, the first key thing to be reminded of is that August is the very worst month for the Dow Jones and the S&P 500, and it has been since 1987. So there is, the old saying, sell in the summer is the mantra for the Dow Jones and the S&P 500. And just having a look now at the screen, you'll be able to see here is the Dow Jones, and the August tends to be a down month for the Dow Jones. Now, that isn't a reason just to go ahead and sell it, but it is to say, August tends to be a weak month for the Dow. So just to bear that seasonal pattern in mind. Also remember, with these seasonal patterns I'm going to go through, is that the seasons can be behaving oddly at the moment because of COVID-19. People aren't taking their normal holidays. It's not a normal kind of life at the moment. So I wouldn't be surprised if we keep seeing the Dow S&P 500 moving higher. That wouldn't be a massive surprise at all. So just to be aware of that dynamic. So that means, there's nothing to stop the Dow, there's nothing to stop the S&P 500 keep moving forward. As in fact, you can see the S&P 500 is looking at making its highest price since February 2020. So it's looking at taking out the highs of February already. So that's just something to be bearing in mind. Now, going back to the main presentation. Also, remember, August is the worst month for the New Zealand dollar and the Australian dollar. And the Australian dollar has seen a fall in all but one of the last 9 years in August. So you can see here, the Australian dollar, during the month of August, you can see that it's fallen in every single month apart from 2014. So if you take a look at the Australian dollar, you can see here, the Australian dollar has been on a real ripping move higher since March 2020 with the COVID-19. We've seen a sharp rise in commodity prices, iron ore, copper, gold prices, all of that supports the Australian dollar. But we have, up until recently, seen a drop in COVID-19 cases out of Australia. Now, they've started to rise with Victoria State being shut down just over the weekend and Melbourne City having a curfew. But that's part of the reason we've seen Australian dollar strength. So just to be aware, with the just with that seasonal pattern, there could be some opportunity for weakness in the Australian US dollar ahead. So do be aware of that dynamic that is in play at the moment, and that could be impacting the Aussie US dollar currency pair. So that's a seasonal pattern to be aware of. And also, 10-year bond futures have risen in 8 of the past 10 years. So if you just going to flick us open to the 10-year bond chart, we just go back here to the main screen, you can see here, this is the T-notes, this is the US Treasury 10-year bonds, and this is their yields. Now the yield of a bond moves inversely to its price. Okay, the yield of a bond moves inversely to its price, and you can see that bond yields were making fresh lows last week, taking out that long-term support level here since March and April of this year. So that's been a significant break in government bond yields. Now, that break in yields is showing a rise in bond prices. So 10-year bond futures have risen in 8 of the past 10 years during the month of August. So that's something to be really, really aware of. And that calls to mind another key thing to be aware of, and this does play into the picture for continued US dollar weakness. We tend to see when the bond yields are falling, that tends to weaken the country's currencies, that tends to weaken the US dollar as well. Now, just going back to the main screen, there's something to show you that's important to know. Now, if you look at this chart here, you can see the gold line is the S&P 500. The blue line is the US T-notes. It's the 10-year government bond yields. You can see at the start of the year, now these tend to track each other. They tend to rise and fall together. So when they diverge, when they go a different direction, take notice. So at the start of the year, we saw the S&P 500 was moving higher, but then we saw bond yields were moving lower. So what we saw lots of people locking in 10-year yields around that 1.6, 1.4%, trying to get as much value as they could. And as they were buying those bonds, the yields were dropping, and we then saw the equity market falling in line with a dropping bond yield. Now, bond traders, the blue line, they're very sensitive to risk. They tend to trade with a 6-month, 1 year, a global outlook. They're looking ahead into the medium-term future. So the bond traders were seeing trouble ahead. You can see here, even before the COVID-19 virus, you can see that as stocks were rising, bond yields were falling. So bond yield traders were saying, by buying bonds and the yields falling, they were saying, we're worried about the future. And the bond trader was right. Now we've got history repeating itself. The bond yields are moving out of those near-term resistance levels that I showed, that near-term support level, which I showed you on the other chart. And you can see the bond yield just moving lower. Oh, and S&P 500 is moving higher. So this is the bond traders saying we're concerned about the future. Now, this is the key thing to understand, is that this doesn't mean to say that equity markets definitely will fall, but here's the rule of thumb. Generally speaking, because the bond traders are longer term, what that means is they tend to have a better insight and understanding into what's happening in the global economy. They have their finger better on the pulse. So the global bond traders are looking ahead 6 months, 12 months ahead, and they're saying there's trouble coming. So on that basis, it's just to be aware. Remember, with August being the worst month for the Dow Jones and the S&P 500, just remember that the bond market is signaling trouble ahead, which could well mean some more weakness coming in the equity markets at some point in the future, as long as that bond yield in the 10-year government bonds keeps dropping. So that's something to be really, really aware of. So keep your eye on that. Now you can do this easily. Let me just show you. All you do is this. Let me show you. All you do is when you go to TradingView, if you want to look at this, you just compare, and all you do is you put your US 10-year. Okay, that's your US government bond 10-year yield. You just pop that on the chart, and there you've got the comparison right there. Okay, and you can watch that happening. So you can see at the moment, you know, you've got equity markets moving higher and bond yields moving higher. So what the thing to keep your eye on is if this divergence carries on, if this bond yield keeps dropping, and yet we're seeing the S&P 500 moving higher, one has to follow the other. General rule of thumb is that the equity market follows the bond market. So that's something to keep your eye on. And particularly if you're trading the S&P 500 or the Dow Jones, that does just give you a nice little bit of insight. So all you do is you go to a US 500 or the SPX for the S&P 500, and then you just compare looking at the US 10 yield chart on the chart. That's all you need to do, and then you can follow it from there. So that's just a little tip that I wanted to give you before we, before that gets forgotten. Also, remember it's the weakest month for the Nikkei 225 and the second weakest month for the FTSE 100. And interestingly, the pound has fallen 8 times in the past 10 years. So the pound is just worth looking at the moment. I'll just show you what's going on with the pound. Right, you can see that the pound is just testing up against that weekly ascending trend line. We've got reasons for bearishness in the pound because of Brexit still to be decided. There is a lot of uncertainty around the outcome of Brexit negotiations between the EU and the UK. So the pound should find sellers. So this could be a perfect place for sellers to enter, with stops just being placed above that 1.3200 handle. Traders could potentially look to move back down into this level here. However, of course, we have to be aware of the US dollar weakness, and there are a lot of the pound's rise has been on the dollar weakness. Now the dollar is finding a bit of strength today. You can see this is the dollar index finding a bit of strength. Now the reason for the dollar weakness is quite pronounced, and it's the US stimulus bill hasn't been arranged. There's falling safe haven appeal of the US dollar. We've got Europe has less COVID-19 cases than the US, which is pushing up the euro, which is pushing down the dollar. The Fed is expected to add more easing, and we saw month-end dollar outflow. So all of that reasons are giving us that we are expecting dollar sellers. So we might see a little bit of dollar strength back up to that 94, 95 handle, and then a continuation to the downside. So just bear that in mind if you are thinking about selling the pound US dollar, that it's not necessarily going to see dollar strength carrying on. So it would be a sort of short-term potential move back, maybe down to that 1.28, 1.29 level, just to be aware of that going forward for any pound sellers that are on the market. And maybe a better vehicle for selling the pound might be something like the pound yen. And one potential way that traders will look at trading the pound yen is, I'll just show you. If you look here, you can see that what you might find, some traders might just wait for a break of that sharp trend line. So a break back into this zone here. Just look at the weekly chart, you can see the price just breaking above that level is indicative of higher prices. So seeing that as price action from there, you might want to see a sell on stop of that 137.70. So any pound sellers who are choosing to trade against the yen, you might want to look at trading 1370 region, stops running above that 139.50 region, and then playing back into this level, and then you're playing back into the descending trend line, and you're back into that zone. So that's just a couple of options for any potential pound traders. Gold and silver are definitely worth looking at the moment. So just take a look at the gold chart. And now there's a lot of speculation at the moment what's going on with gold. Gold's been on this massive rip higher. There's so many bullish reasons for gold medium term. We've got low interest rates around the world. No Federal Reserve rate hikes in for the next 2 years. There's mass money printing by central banks that devalues currency, that make gold more attractive. Poor returns are expected in the equity markets going forward. There's tensions between US and China. We also have US elections approaching, lots of risk there. Expanding case count of COVID-19 cases in the US. We've got gold taking out all-time highs, that 1920-21 level. This was significant. Whenever you see a currency taking out all-time highs, pay attention. And that's what happened. This is the all-time high for gold, this 1920 region here. was taken out. Now on the weekly chart, you can see that price broke and closed above that level. So that's significant. That means that 1920 zone is currently support for gold. So whether that zone will hold or not, it's too early to tell. No one obviously knows the future. But that's significant, the fact that we've got that weekly chart. So we would expect buyers on any returns that 1920 zone. Now, one thing to be aware of is we've got this quite sharp trend line forming here to the upside. So if we are going to see a breakout to the upside, look for a break of that level. A break of that 1989, 1990 level opens up the way to 2000 and beyond. So that would be a very key trend line break for buyers. So some buyers will buy on stop and they'll make a move higher, and if price comes back into that trend line, they close their position. So it will be looking at a 4-hour chart, break above, stay in the trade, break above, get back below, get out the trade, and looking for a run up to that 2000 level and beyond. So that's what we're looking at on gold. On silver, again, we've seen huge rises in the silver markets, absolutely ripping forward, and the near-term support that we'll be seeing in silver is this is the trend line. This is how, when I got into silver, was just breaking out of this trend line. You can see that trend line break was a fantastic entry for silver, and that was the trade that I took. Now, in terms of getting back into it, I would be looking from a longer term perspective. I would expect to find buyers on any kind of return to that 50% Fibonacci retracement level. So I'd expect buyers anywhere around that 2150 region. You would expect to be finding buyers coming back into the market. 2150, and looking at stops just running below that trend line there, looking for a play back up towards the high. That's what you'd be expecting with the gold chart. And obviously that's something really to keep your eye on going forward. Gold and silver have been huge runs, and the fundamental picture is very much still in favor of more upside. Now, what would change this outlook is if we saw a rapid recovery in COVID-19. If there really was a good recovery, we started seeing a really successful treatment for the cure, and people stopped isolating, and we saw central banks starting to raise interest rates. That's the key thing. This gold strength is benefiting a lot from the weak US dollar, which is because the Federal Reserve is adding so much easing, because of so much almost unlimited quantitative easing by the Federal Reserve. That all weakens the US dollar. Bond yields are low, that weakens the US dollar. So if we see central banks raising interest rates, feeling optimistic, recovery's on the way, then we'd expect some of this gold upside to dissipate. So that's the alarm bell to look out for, if you like, in terms of the gold trade, the gold situation. Now we're going to look at the key events for the coming week. We're going to look at our calendar. So just go into our economic calendar here. And starting with the 4th of August. Now, this is the first key event we've got coming up. Okay, just before that, actually, the first key event we've got is ISM manufacturing PMI data. Now, this is out of the US manufacturing. Now, the expectations are that with the US having to start more lockdowns again, Florida had rises in cases, so did Texas, so did California, and we started seeing some states locking down again, restricting their growth. So we're expecting to see a drop in PMI data point. The lowest figure expected is 49. So 49 and below is below expectations. Highest is 57 above. So the risk here is if we get a high reading, that would really reassure the market. So 57 and above would be very bullish for the S&P 500 and bullish for the Dow Jones. So look at that figure. Anything above 57 would be bullish and one to keep your eye on. Now, the other key event coming up is the RBA cash rate. That is coming up this evening. Now, they're expected to keep the interest rates unchanged, but because we've seen the increase in COVID cases, Victoria State, the second most popular state in Australia, has declared a state of emergency. Melbourne, the city of 1 million people, is on curfew. And this means that the short-term situation for the Australian dollar, the RBA may be less optimistic than they were at their last meeting. So some analysts are thinking that the rising COVID-19 cases, Australia-China tensions after Australia criticised China for the Hong Kong legislation, that the RBA might be looking to talk their currency lower. They might be start stressing stresses and strains that they have, in which case this is a very interesting currency pair here. This Australian-New Zealand dollar pair. As you can see that moving back up into this area here, which could be considered suitable for shorts. There is a bias on the Aussie-New Zealand dollar currency pair to the sell side. Because of Victoria State shutdowns and the fact that the RBA is expected to be dovish tonight, means that there is a sell bias on the Aussie-New Zealand dollar, and that could be an area where you'd expect to find sellers actually coming into the market. So this current region, around that 1.07439, you will expect to find sellers coming into that, looking for a break of this trend line that's moving upwards on the 4-hour daily chart. You can see that 4-hour trend line. You can see that price is just trying to, break, finding some support there. But the overall, the overall outlook for the Aussie-New Zealand dollar pair is potentially bearish. So with the RBA expected to be more bearish, there are indications that we'd find sellers in at that level. So that's where we would expect to find some sellers coming in and would be suitable for shorts. Now, a couple of things to be aware of looking at that is what might change this outlook. Well, there's one obvious thing that would change the outlook, and that obvious thing that would change the outlook would be if there was the RBA was more optimistic, if the RBA had a greater sense of optimism about what was going on, about what was ahead, that could see some more Australian dollar upsides. That's certainly one to be looking out for, that the RBA are not optimistic. If they're pessimistic, that would obviously be suitable for sellers, and you'd expect sellers right at this level here, and you expect them to step in, and you'd expect to see stops just running above the recent highs, that 1.0850 level. You'd expect to find sellers there looking for some traders taking profit at that S2 level, other traders waiting for a break at that level, obviously being aware that the RBA event coming later on today is a risk for the pair. So that's something to be aware of as we look at the RBA meeting that is coming up later. Now, going forward into the week, we also have on Wednesday, we have crude stocks. Obviously, don't forget the private data that comes out early the night before on Tuesday. So there will be some Tuesday data crude stocks. Obviously, a draw in inventory. If there's a draw in numbers, that is bullish for oil. If there's a build in numbers, that's bearish for oil. But remember, oil markets at the moment are pressured. And the reason they're pressured is because the concerns are that with rising COVID cases, rising COVID-19 cases, the demand is just not going to be there. So there's concerns that the oil markets are going to fall. There's going to be an oversupply in the market. The demand won't be there. So the concern is that there's going to be some oil sellers coming into this market. So be aware of that pressure. Also, going forward, we have the New Zealand unemployment rate. That will be obviously important for any trades taken out the Aussie-New Zealand dollar. That's tomorrow evening. We have some PMI, a swathe of PMI data out of Europe. Key thing to look for Europe is the rising COVID-19 cases. If we see more and more cases rising in Europe, that's going to weigh on the euro-US dollar. We saw a great run in the euro-US dollar coming into last week. It's moved right up to that level, but crucially, you can see we haven't been able to take out that high level here, and prices move back into that zone. So would expect medium-term buyers for any retracement back down to that 1.1650. We expect medium-term buyers there, but just be aware, seeing some weakness now in the euro-US dollar, and that is, to be noted, and the fact that we have this PMI data coming up during the session, that is important, not during the session, for 5th of August, during London session tomorrow morning, whole sway the PMI data. So that's risk for the euro. Anything that starts seeing big drops in these PMI data would be an alarm and result in more euro selling. So be aware of that, particularly with the German data and the European data as a whole. We have the services PMI data out on Wednesday as well. That will be important for the US. The US is a service-driven economy. 70% of all of US's GDP comes from the consumer. So services data important there on the PMI. Maximum expectation 60. Anything above 60 would obviously be very bullish for risk. You see that boost US stocks. So something to be aware of. Then we have the main crude inventory numbers that are coming. Labour data will be important here for New Zealand. You can see that the market has a number of different data points out from New Zealand. The main rate event is next week. So those data points will be used by the RBNZ to see which direction they're using. So obviously, if anyone's short Australian New Zealand dollar, you need to factor in those data points as well. Key event here on Thursday is the Bank of England rate decision. Now, the Bank of England is expected to keep rates unchanged at 0.10%. That is as expected. The other thing that to be aware of with the Bank of England is that Andy Haldane is confident that the UK is just going to have a V-shaped recovery. So there is a bit of optimism from Bank of England's Andy Haldane. If we see any indication of or any talk of negative interest rates, we'd expect heavy pound selling. So look out on Thursday when we get the rate meeting. If you have a hint of negative interest rates, anything like that, or if the interest rate changes, obviously if there's a cut in interest rates, we'd expect heavy pound selling. So be aware of that on Thursday. That's a big risk event for the pound. Then we go into Friday, and on Friday we have a few important data points. Have obviously some data out of Germany. That will be important for the Eurozone because, you know, Germany is the largest contributor to the Eurozone. So what happens in Europe, in Germany, is closely followed. So look out for that data. Just forgot the jobless claims out of the US. Again, that's very important, because the US is a consumer-driven economy, and that can only be driven when people have jobs. So if people are losing more jobs, if the initial jobless claims goes up to 1.5 million, 1.4 million is expected, but if you get 1.5, 1.6 million above, then the market will be concerned that more people are being unemployed. That will be a big concern for the market, particularly because the market wants to see this number going down. Now, the continued jobless claim is arguably the more important figure, because this shows how many people are still out of work. So at the moment, we've got 17.3 million maximum expectations, 16.8 expectations. If we get anything above 17.3 million for the continued jobless claims, and anything above 1.5 million for the initial jobless claims, it shows that more people are out of work in the US and more people are going out of work. That will weigh on risk. So look at the jobless claim very carefully here. Market has been eyeing this data, very important. And of course, this flows in to non-farm payroll data on the Friday. So earnings are very important. Unemployment rate, what are the government payrolls, are absolutely crucial and will be looked at very carefully. Expecting non-farm payrolls here, expecting a rise of 1.6 million in jobs. Anything, if we get minus 280,000 or a plus 3.5 million, that's the minimum maximum expectations. Obviously, quite wide range of expectations. But 1.6 million before, 4.8 million before that. That was that incredible surprise month. So if we see jobs being created, that alleviates investors' concerns. That's what the markets wants to see. We start seeing jobs, falling minus 280,000. Anything below that will change risk appetite. There's a little bit of Canadian data as well about Canadian employment. that will be released at the same time as non-farm payroll, but that has impact for Canada as well for similar reasons. And obviously, if things are looking bad for US, that also impacts Canada. Canada has a great trade relationship with the US, being neighboring countries. If the US does badly, then Canada can get dragged down along with it. Do have some important data out of China as well, just to trade balance, exports, imports, markets wants to see that keep ticking along. Any trouble out of China can also impact risk. Remember, between China and the US, that's 40% of the world's GDP. So big day on Friday. So expect going into the week, the markets start quietening down from Thursday afternoon. So after we've got the Bank of England stuff out of the way, then Thursday afternoon, expect markets to calm down after these initial jobless claims and just to go into kind of cruise mode ahead of NFP day on the Friday. Okay, let's go back to the main screen. That's the main things to be looking ahead. Don't forget your intermarket correlation. Take a screenshot of this if you haven't already. If you've got a lower volatility index, you've got stocks rallying, commodities rising, bond yields rising, that means risk on. And a risk on market, you tend to see high beta currencies strengthen, Aussie CAD, New Zealand dollar get stronger, safe haven currency weaken, Japanese yen, Swiss franc, US dollar get weaker. If we have higher VIX, stocks falling, commodities falling, bond yields falling, that's risk off. And in risk off, we see the exact opposite. We see the high base currencies weaken, Aussie CAD, New Zealand dollar gets weakened, safe haven currencies get stronger, yen, Swiss franc, and US dollar. So be aware of that going forward. Don't forget, one of the big things carry on is earnings seasons are continuing. So we will have more data release from US companies, can impact risk. We saw a good example last week when the NASDAQ made some fresh highs after the Facebook, Amazon, Google, really announced much higher than expected earnings. So that tech stocks are really helping the US at the moment and is expected to carry on. Obviously, everyone at home, people are using Amazon, people are using Netflix, they're advertising on Facebook. So of course, we'd expect these companies to do well in the current environment. High volatility. Volatility, I was reading a Bloomberg report this morning. The CBO volatility index goes up about 11% for the month of August. So more volatility. The reason for that is that there's less traders around, which means that price can move on a lot less. There's less orders in the market. And surprisingly, when you've got less orders in the market, it means that price can move in a wilder swing. It's trying to find an order. It jumps over price looking for fills. That's when you see higher volatility. So expect that higher volatility, bigger price swings in August. Look particularly for the gold market. If gold could rip out, I think this could be the month it could, because of the high volatility. You could really see a short, sharp, hard move higher in gold. Look out for that, and look out for that break of that trend line, which I showed you on the 4-hour chart one to look at. Of course, COVID-19, this is the fear that a second wave is going to come. It's going to slow down economies. That's what could weigh on the stock markets. Look for that this month. If we see rising cases in Europe, more shutdowns, more, sadly, gloom and doom about the economy, then this could be the catalyst for causing a correction in the S&P 500 or the Dow Jones. Remember 1918, when there was a Spanish flu outbreak, the second wave was far more deadly and widespread than the first, 5 times greater. We're starting to see that now in the US. We're seeing that second wave pattern. If it extends across the world, then look for news of government shutdowns, company shutdowns. That will mean that there'll be pressure on equity markets, and we'd likely see some of those seasonal falls coming into place. That's certainly something to be looking out for the month of August, just keeping an eye on what's happened in the equity markets. I hope that's been helpful for you guys. I hope that's really just to help you get ahead. We're looking at some different trades at the moment. Shua Aussie Yen Long. Now, Aussie Yen Long, let's have a look at this. The problem with the Aussie Yen Long at the moment that I've got is that we've got reasons for Aussie weakness, because you've got the Victoria State sense of emergency and we've got the dovish RBA expected. So that's my problem with an Aussie Yen Long. And let's just look at markets as well. So we've got In your favour, Shwa, we have got European equity markets moving higher. S&P 500 futures currently flat. We have bond yields moving higher. We got crude prices up. We have US copper prices a little bit higher. Gold, silver a little bit lower. Let's take a look at the currency space. And we can see in currencies, we've got Aussie dollar is weak. We have New Zealand dollar a little bit weak, a little bit of CAD strength. And we're seeing a little bit of weakness in Swiss franc, Japanese yen. So quite mixed market. So in terms of intraday, I would be neutral this pair, Shwa. I'll be neutral on the Aussie yen long. I wouldn't have conviction for much upside or downside in that at the moment. Yeah, Titus. Possibility of a repeat of a second wave as it happened with the Spanish flu. Will investors pay more attention to precious metals or safe haven currencies, i.e. the dollar? Yeah, Titus, it won't work like that. So it's not like that they're going to see, let me just make sure I'm showing the right screens. Oh yeah, hang on. Just going. Yeah, so what? It's not. They're not going to say, "Oh gosh, there's a second wave. I'm going to pay more attention to precious metals or safe haven currencies." And the dollar, particularly at the moment, is not acting as a safe haven currency at the moment. We've seen all that dollar weakness. So what they'll pay attention to is the pace and the speed of slowdowns. That's what they'll be looking at, is if we're in a second wave, which companies are slowing down. Now, if the companies are slowing down, what you'd expect to see is bonds will increase in price. So you expect bond yields to fall. We'd also then expect to see equity markets to fall. But remember, the Federal Reserve is stepping in, Titus, and having a lot of stimulus, and that's what's been supporting the equity markets recently. So that's why we've seen, despite all these government shutdowns, we keep seeing the S&P 500 being bid from support. US stocks keep moving higher on the Federal Reserve's. Basically, you're underpinning the market. Whatever happens, the Federal Reserve, we're going to support the US economy. That's why the stock markets are rallying, okay? So if we see a second wave virus, as long as those support from the Federal Reserve comes in, then that can keep rallying even with a second wave. So the Fed, they'll be paying attention to the Fed policy. And but one thing is sure, is if we do see a second wave of virus coming in, then that would be very bullish for gold, because you expect yields to drop even lower. And with yield dropping even lower, that makes a gold even more attractive. So we'd expect to see a weaker dollar, and that would boost gold. And as I said, I'm looking very carefully at this trend line. See, a break and a close above that trend line opens up the upside at 2,000 and above. So that's something definitely to be looking carefully on. A swing trade, ideal. Any 1825 region is just ideal for buyers. Any returns that 1850, 1825 on a pullback would be excellent for longer term buyers. Hope some of that helps, Titus. Obviously, they'll be keeping an eye on the pace and the speed of COVID-19 breakdowns. Don't forget, on Wednesday, we have another workshop that is here for HYCM clients. So if you are not an HYCM client, could I recommend that you join the workshop? It's a great way of coming along, asking more questions. I can also give you some help with your trade ideas, tell me which trades you're in, what you're looking at, give me your rationale. We can talk things through. It can be a great learning curve. I'll also show you a dominant currency pair that I'm be looking at for that day, and that is on Wednesdays at 12:30 GMT. I said this is only for HYCM clients, so if you're not an HYCM client but you want to come to this workshop, please do become one of our clients, and it would be great to help you with that. So thank you everybody for coming. It's been great to have you as always, and I look forward to seeing our regular guys on the Wednesday. Sammy, Selva, Salvatore, Shwa. It would be great to have you there on the Wednesday as per usual. Everyone else, thank you very much for coming. Particularly welcome. Nice to have you, Titus, here for the first time. Charles, thanks for coming. Hashik, great to have you as always. Mahendra, Mohammed, Oluwatobi, great to have you, and Omid, Rick, safe. Thank you, everybody, and anyone else that I've missed. Thank you very much for coming, and I look forward to seeing you guys on Wednesday. Take care now and have a very good afternoon. Thank you.